Hey everybody, welcome to That Expert Show, where you help run the show. I'm Anna Canzano. Thanks so much for joining us. We are talking about tax strategies today. This is one of those things where, we're not really taught how to do our taxes in high school. At least I was, and I might have been shown how to do a 1040 EZ, but I don't remember being shown how to fill out the W-4, the form that you have to fill out when you go get your first job. And these are very basic, fundamental things that I think we all should know. At a more advanced level, if you're filing for yourself, your household, or maybe you own a small business, there are tax strategies that you ought to know about because the tax law changes every year. In fact, there are changes that are applying right now this year that you'll want to know about. So we've got a great guest lined up. He is the past president of the National Society of Accountants. He is a partner in an accounting firm and has been practicing for more than 25 years, helping individuals and small businesses with tax preparation and accounting. He joins us live from Little Rock, Arkansas. Brian Thompson, thank you so much for being with us.
Well, thank you for having me, Anna.
Brian, we were talking just a little bit going into this show how, we kind of go into life sometimes just learning and making mistakes along the way when it comes to taxes. So let's begin with that very basic notion of the W-4. You go get your first job, your employer hands you this piece of paper. What should you know about filling out that W-4?
Okay, so what you should know about filling out the W-4 is that for 2020, starting year 2020, the new W-4 is totally different from the W-4 that you may have filled out in the past. In the past, you would tell your employer how many allowances you had. Maybe you're claiming married or single with 1, 2, or 3 allowances. The new W-4 still wants to know whether you're married or not, but it works on a tax credit system. It wants to know how many credits in dollars and cents that you may have based upon the children or dependents that you have in your home. It also wants to know, do you have 2 jobs? Does your spouse work? Check the box if those two are relevant, because if you don't, it could cause the incorrect amount of tax to be withheld. The new W-4 also wants to know in dollars and cents how much your deductions exceed the standard deduction so that the payroll tables can make an adjustment to adjust your withholding accordingly. The new W-4 also wants to know, is there other income that you may have that you want withholding applied to it? If so, list that amount in dollars and cents. It also can ask, or the new W-4 has on it, where if you want additional withholding, you can add that. And that's similar to what the old W-4 that had on it. And then one last thing, the new W-4 currently does not have a place to mark or to write that you're exempt from tax. And that's a substantial change from the old W-4 as well. So the new W-4 works in dollars and cents. The old W-4 worked in allowances. And so it's just going to take a new mindset to fill that out correctly.
That is a huge change. And when it comes to filing, how do you know how to file? I mean, if you're single, you obviously file that you're single, but not all married people necessarily want to file or should file that they are married, right? Like some people file that they are married, but they file separately. Can you help us understand the advantages or disadvantages to those strategies?
Surely. So sometimes in life, there's reasons to file separately. Oftentimes, those may come about where a taxpayer has, or a spouse has some old issues in their tax closet, as I like to call it, is they may have back child support that's an issue. They may have back taxes that they owe to the Internal Revenue Service. There can be issues in that person's past that can cause their refund, if a taxpayer is eligible for one, to be garnished or be taken by the Internal Revenue Service. And then they come and marry a spouse. And now the question is should that spouse file jointly? And if they do, any joint refund that they would be eligible for is now going to be taken by the Internal Revenue Service if there's issues in that person's closet that's coming forward. So that's one reason to consider to file separately is that you don't want to, put your refund at risk for the spouse that doesn't have any problems with the IRS. Another reason may be is that, one spouse may be self-employed and the other spouse may not. And the spouse that is not unemployed or not self-employed may not want to be at risk for all the additional taxes and self-employment taxes that their spouses may be liable for. They may have not a clue what's going on in that business. They may be a new married couple. And so, they may not want to file that joint return to expose one spouse to a large tax liability. And then, of course, you have the other situation where you have spouses that simply aren't getting along. And, spouses that keep their financial lives separate. And when that happens, you're not sharing information about the other person's income, deductions and that. And so in those situations, you're kind of left with no choice but to file separately.
I see. Going back to the W-4 for just a moment, is there a strategy when it comes to the number of allowances that you put down when you go to get that job that you might advise on?
So that strategy depends upon, let me first say that the new W-4, if you fill it out as accurately as it could, it appears that the strategy in the new W-4, as far as the intent of the Internal Revenue Service, is to try to break even as far as your tax refund or balance due. It's try to get you as close to breaking even as possible. So therefore, if you want to deviate from that intention, the only way you can do that is to, is to adjust the numbers that's on the W-4. For instance, let's say that you're a taxpayer that has 2 dependents that are under the age of 17. Now, normally, a dependent that's under the age of 17, the taxpayer is eligible for $2,000 per dependent. So that's $4,000 in tax credits. If you indicate that $4,000 on your W-4, your withholdings will be adjusted accordingly, meaning that your employer will withhold less taxes because you've told them that there's going to be a $4,000 tax credit on your return. So consequently, if you're trying to create a refund on your return, you may only want to list $2,000 worth of credits or $500 worth of credits if you would have 2 qualifying dependents. Okay, so consequently, going on the flip side, you wouldn't want to indicate that you have $6,000 in dependents or $6,000 in credits, because that could require you to pay $2,000 when it comes for filing time.
And so really this comes down to that concept of, do I want to be in charge of my money over the course of the year, or do I want the government to hold it for me, right? I mean, isn't that kind of the tension between the two ideas?
Yes, that is true. You also have to realize that some taxpayers do not have the ability to save, and they in the past have used the government to save for them. They'll receive a large refund at this time of the year, $3,000, $4,000, $5,000, $6,000, and they're planning on that because they plan to use that money for vacation or to buy, something new that they need, but not having the ability to save, per paycheck as they went through the year.
Right.
So, that's going to be a different mindset as taxpayers begin to face these new W-4s.
Interesting. Okay. What is the advantage to having a professional do your tax return? I mean, let's talk about, different scenarios. A woman in her 20s who's working her first job, and she's making, let's say she's making anywhere from $40,000 to $50,000 a year, versus someone in a higher income bracket who's making $75,000 to $100,000 a year. What is the point at which you go beyond filing that 1040 EZ on your own, doing it for free, or using TurboTax? When does it cross the threshold into, you really should hire somebody to do this for you?
Yeah, so I'm not so certain that there's a dollar number for that. I think really the decision comes about is there something that's changed for you? So you mentioned the first job. I do a lot of first-time tax filers, where so the other issue is how comfortable do you know the terminology? Do you know what you're doing? Do you know what some words mean? Tax credits, tax deductions. What are the tax deductions that's relevant? So professionals know these things, as far as what tax deductions are relevant for some people. They help individuals avoid mistakes in filing their return. They offer a convenient service where, hey, you can bring the stuff to your professional, and because they know what they're doing, they can file a complete and accurate return for you. So I'm not so certain there's a dollar amount. Certainly, what can be the case is that the more income that an individual has, the more complicated a return could become. Because as individuals make more money, they tend to do things with that money. They may buy rental property, which adds another level of complication to return. They may make investments and buy and sell stock. And now all of a sudden we bring these capital gains and capital losses and tracking those type of things. So I think what you're saying here is that possibly the more income that a person has, the more potential complication that person can be in. And, therefore they should enlist the help of a professional.
Well, yeah, and the professional too will be, up on all of these changes and trying to figure out a tax strategy, a tax plan that will actually work
Right.
for you and help you become more efficient. When it comes to trying to avoid an audit, I mean, an audit is like a 5-letter dirty world in the world of taxes. How do people avoid an audit? Are there certain things that trigger an audit?
So there are, the way the recent tax law has changed some things. It's reduced some of the exposure to an audit that some taxpayers may have experienced before. But typically, the things that trigger an audit are the things that are out of the ordinary. So, what is out of the ordinary? There are national statistics that the Internal Revenue Service, federal government, tracks for certain types of deductions that taxpayers have. And when your return exceeds those national averages, that can be a reason or a trigger for an audit. So when those things occur, you certainly want to always have documentation and backup for anything that's claimed on your return. So therefore, if you are pulled for an audit, at least you have the supporting documentation that can support the deductions and income types that you claimed on your return. So basically, audit triggers are determined typically by things that are out of the ordinary on your return. There is one other type of audit, which is what I call kind of a lottery audit. It's just your number gets called for no apparent reason other than to update the IRS's statistical database. So in those, unfortunately, it's like winning the lottery, but at the same time losing it.
Yeah, right. And so you should be keeping records really going back how many years? Is 3 the magic number or more?
Well, our policy at our firm is we recommend that clients keep 7 years worth of data.
Wow.
At any point in time, you're exposed for 3 years. The IRS can go back and audit you for 3 years. If the auditor should find something in those 3 years that is substantially wrong, they can open up the previous 3 years. So our 7-year policy kind of takes into effect the year we're in right now, which is 2020, and then the 6 prior years. And that just makes sure that we've got the data if to support that audit if it should take place.
So are you not a fan of like paperless billing then? How that's obviously environmentally the push for everybody, but oftentimes records are hard to obtain if you've gone the paperless billing route and you have to go back, 6 years or whatever to get records that a company then has to print out for you or email to you in a PDF.
It does make it a challenge. I will tell you that. I have some clients that they get the bill via email. They pop it in a folder. It stays electronic. If something comes up, they simply send me or share me that folder with the receipts and everything in it. So, but if they have not stored that receipt themselves, then, we're in a difficult situation that now they do need to contact that company. And that produces some challenge because, there has been cases where the company that they're trying to contact is now out of business and they can't get records from them. So, there are challenges when, everything is electronic in nature.
Yeah, that's a very good point. Let's talk a little bit about IRA, Roth IRA, 401k strategies, because this is such a big piece of reducing your taxable income and really, benefiting your life in the long term that people overlook.
Right. Okay, so, the prudent thing to do is starting is that you should save for retirement, right? And the way our government system is the government's willing to give us or allows us to exclude a portion of that retirement from our income. There are various ways to, contribute to retirement. If you work for an employer that has a 401k plan, you can contribute to your retirement that way. If you work for an employer that does not have a retirement plan, then you can set up an IRA, a traditional IRA, to take a tax benefit or a tax deduction for the amount that you contribute to your IRA. You may also work for an employer that has a 401k or a retirement plan, and you may be eligible to contribute to your IRA along with the 401k. There are some income limits that affect the ability to do that as far as take a deduction for the amount that you contribute to an IRA. But if you have the financial means and wherewithal, certainly you can contribute as much as you want. There's limits on how much you can contribute to a retirement plan. Your other alternative, as we had spoken about before, is a Roth IRA. Okay, a Roth IRA is traditionally appealing for a younger person who has a longer distance before they get to retirement. The Roth IRA allows a person to put money into the retirement. They don't take a deduction for it now, but it grows tax-free until they choose to pull the money out in retirement. And the benefit of the Roth is in retirement, it's not taxable then. Whatever the earnings have grown to, whatever money is pulled out of it, they simply don't pay taxes on it. So that's very appealing to younger people who have a lot of growth time between now and retirement.
Help me define young person. Is that someone under the age of 30, 40?
So it depends on when that person would like to retire. Okay. I have people that, could be in their mid 40s to 50 and still contributing to a Roth IRA because, hey, they're going to have 10 years, 15 years of growth in that IRA, in that Roth IRA. The other thing to factor in is which type of IRA you should put money into also depends upon what tax bracket you're in. For instance, if you're in a low tax bracket, which I'll deem as a 12% tax bracket, if you put money into a traditional IRA, you're getting 12% tax deduction for every $1,000 or $120 for every $1,000 you're putting into that traditional IRA. Well, if you elect to pay taxes on that $5,000 and instead put it into a Roth IRA, it's causing your taxes to go up 12%, but it's also growing tax-free over so many years until you pull it out in retirement. So, the other factor is the income and what tax rate that a person is going to be in.
Interesting. That's the best advice usually that I try to give to younger people is that they really should be thinking about their retirement from the very first paycheck that they receive because they have the benefit of time.
That's right.
Let's talk a little bit about small business strategies. What is your best advice here in 2020 for small business owners and how they can be smart when it comes to taxes?
Okay, so most important recommendation for small business is keep track of your expenses. Keep track of your expenses. Set up a separate bank account to track or to run your business through that that separate bank account. Disconnect it from your personal, savings, personal checking account. Create a unique path for all your business transactions. And then run everything that's associated with your business through that business account. Okay. And the reason being is because if everything is going through one account that's business related anyway, it makes it very easy to track and very easy to know what were the expenses of that business. If some of your expenses are coming from here and some of them are coming from there, some of them are cash, things have a way of disappearing. Cash receipts have a way of disappearing. And if you were to get an audit and you claim those cash expenses and now you can't support them with a receipt, you're at risk of losing that deduction because that simply disappears. So my biggest advice is to keep track of your expenses, and a good prudent business person, would have a separate business account for those expenses. Now, the reason why those expenses are so valuable is because someone that has a business of their own, and let's pretend we're self-employed, any profit that self-employed business has is going to be hit with an extra tax called self-employment tax, which is 15.3%. That's up on top of your regular income tax. So if you're in a 12% tax bracket and you're self-employed, you could be paying taxes at a 27% tax rate. If you're in a 22% federal tax bracket and you add additional 15%, that's a whole lot of taxes.
Yeah,
that is a whole lot of tax. So every deduction that you fail to keep track of or that disappears, you're costing yourself an extreme amount of tax.
Yeah, that makes sense.
So you need to keep track of your expenses.
Speaking of expenses, when it comes to things like health savings accounts, is this something that you find most people are making use of in the best way possible?
So HSAs, which is a health savings account, they're becoming more and more popular. Okay, as the cost of insurance plans have risen, a lot of employers have went to high deductible health insurance plans and offered HSAs to their employees, and then some people will purchase HSAs on their own outside their employer. So health savings accounts are great because it allows a person to reduce from their taxable income. In other words, if they're employed by an employer that has an HSA that the employee is participating in, their taxable income will have lowered by the amount that the employee contributes in their HSA. So they're not paying taxes on that money. And so then they have the ability to use those funds for health-related expenses. Okay? And the difference between, the flexible spending account that's, that we had in the past was in a flexible spending account, there was only so many dollars that could carry over at the end of each year. With the health savings account, there is no limit. So if you put as much money as you can into that HSA and you don't use it all for, health or medical related expenses, whatever amount is left in there at the end of the year carries over, automatically rolls over into the next year. So you can build that health savings account to a period or to an amount that maybe you need it for later when you get older. And what happens with a lot of my clients is that I see as they get older, a lot more medical bills come their way. And it would be nice to be able to have a fund there, a savings account that they could use to pay those increased medical costs.
Right.
So I won't say that people may be using it the correct way because a lot of people don't have the wherewithal. They don't have the financial means to, put as much money into that HSA as they can. A lot of people are using it similar to what they were using with the flexible spending accounts, is where, hey, I expect to have $2,000 worth of medical, so I'm going to put $2,000 in my HSA. And the reason is, well, that's all I can afford to do. Any more would put them in financial strain. So I see a lot of that situation as well.
Let's talk about grouping deductions. This is an idea that I think I might have heard about from you in our pre-interview, or maybe I read about it somewhere. but it's the idea that you don't have to take all of your deductions at once, or like on a yearly basis. You can lump them together and receive more benefit from doing so. Can you explain that idea to me?
Okay. Yeah. So what you're referring to there is what I call bundling or bunching your itemized deductions. Now, keep in mind that we are all cash basis taxpayers. And what that means is in the year we spend the money, that's the year that the deduction is applied to. Okay. And so what makes this bundling and bunching more popular now is because the standard deduction has increased so much. So, if you're a single individual, the new standard deduction is like $12,200. If you're married filing a joint return, the standard deduction is $24,400. So it makes it very difficult for a lot of taxpayers to accumulate in a year's time enough deductions to take advantage of our tax system. And so one way to get around that, or to try to get around that, is to batch our deductions into 1 year. So let's consider charitable contributions, because those are typically ones we have discretion over when we choose to give to a charitable organization and when we don't. So let's pretend for a second that you would ordinarily give $10,000 away to charity. Okay, and furthermore, let's pretend that that you're married filing joint, and so therefore your standard deduction is like 24 grand. Okay, $24,000. Mm-hmm. So if we give $10,000 to charity, and our state and local taxes are capped at 10, we'll pretend we reach the cap, and let's say we have $5,000 of mortgage interest. So we have $25,000 worth of itemized deductions in my example, just barely enough over the standard deduction. Mm-hmm. So the benefit that we're getting, assuming what tax bracket we're in, is $600 times whatever tax rate we're in. So we're only getting a fraction of a benefit from a tax perspective. Mm-hmm. But now let's pretend on January the 1st, we make our charitable deduction of $10,000. And on December 31st, we make another charitable contribution of $10,000 the following year. So now we got $20,000 of charity. So now on our tax return for that year, our itemized deductions have increased by $10,000 that year. And so now we're getting a $10,000 additional deduction at whatever tax rate you're in. If you're in a 12% rate, hey, that's $1,200. If you're in a 20% or 22% tax rate, that's $2,200 tax savings. So we can get a tax benefit by bunching our deductions into that 1 year. Now the following year, which would be a calendar year, we may not have any deductions, any charitable contributions for that year. But you know what? We still get that standard deduction of $24,000+. So we really didn't lose anything. So the moral to the story is that sometimes it's good to be able to batch to bundle your deductions into 1 year, if at all possible. You would also do that with medical deductions if you have but it would take a lot of medical deductions because those have some special requirements. They have to exceed 7.5% of your income on current law. So those are a little bit more difficult to deal with.
Mm-hmm. Interesting. You can't always predict what's going to happen with you medically either. Can we talk a little bit about inheritance? And then I also want to answer some of the questions that people are submitting via social media. How do you pass on your inheritance and pay the least taxes on it, or have the most tax efficient strategy for passing that on?
Okay, so inheritance, when someone passes away, inheritance is those assets that a person has, they go to other individuals. The general rule is that most inheritance is tax-free, that there is no taxes on it. Of course, someone can have an estate that exceeds the annual allowance, but for, that number is what, $11 million and some change. So it takes a pretty good estate, and before we're talking up there. Most individuals especially that I deal with, are way under that as far as an estate plan. But so in that, most inheritance to the receiver is tax-free, and to the person who passed away, it's tax-free as well. Now, there's one caveat where it's not tax-free, is if the thing that's being received is a retirement account. So, we were talking about IRAs earlier, and traditional IRAs. Traditional IRAs are monies that no taxes have been paid on. Those are what's called deferred income. And if that's passed through to an individual who has inherited it, that person will pay taxes on those funds when they withdraw them. You may have real estate and stocks and things like that. There's special things in regard to that. The real estate and stocks is the real estate gets a step up in basis when a person passes away. Now, what that means is the individual that previously owned them, they paid something for that stock. They paid something for that real estate. But however, when they pass away, the new cost basis of that property, of that stock, becomes what it was worth on the day they passed away. So the person who inherited it now gets the new step up, the new cost basis, which really doesn't play a role in what the person who passed away paid for it. And so if they would sell that real estate soon after they inherited it, there's likely to be no tax consequence on it, because they're selling at what the new cost basis is, at the date of death. So, so one of the strategies is, when you have an individual that's maybe up in age that has, real estate and has, whatever their estate is, rather than gifting it out to individuals, because there's a difference here when we're talking about a gift. If, Anna, you were to receive a gift from a related party, whatever the cost basis that the person who gave you that real estate or that stock is, whatever their cost basis in a gift becomes your cost basis. Mm-hmm. Now, they may have gave you, some Walmart stock that they paid $20 a share for, and it's split, 20 different times, and now is worth a whole lot of money. But if they give it to you, your new basis in that would be, $10. Compared if you sold it, it may be worth $10,000, whatever the number is. Mm-hmm. Compared where if they passed away and you got it through inheritance, then you may not pay any taxes at all because you got the step up in basis. So, it's good, in when cases that it can happen is that the person maintain their assets and let it pass through inheritance if possible. Just so that, especially on things that have appreciated in value. If you bought a piece of real estate, for example, a lot that was worth that cost you $50,000, and it's $50,000 now is what it's worth, it isn't going to matter. Mm-hmm. Okay, from a tax consequence, whether you inherit it or whether you gift it, there's going to be no tax consequence on that gift because the cost basis is the same. But on appreciated values of things, it's good to try to hold on to those and let them pass through inheritance if possible.
I see. Interesting. I wanted to get some of these questions answered that people have submitted. Teresa, for example, says that her husband just passed away last July and he always did the taxes. She knows nothing about them, so she needs help. She needs to know what to gather to take in to an accountant, presumably, and will it be harder because he's passed away?
Well, certainly it'll be harder on her, with him passing away, considering that, he handled that situation before. So a couple of things that I would suggest. One is that she keep an eye on the mail, okay? Because a lot of the tax type records are mailed to taxpayers, and on the outside of the envelope, it will say important tax information. So the mail can be, a resource to gather the actual government documents that someone's going to need to help prepare that return. The other thing I would suggest is to get a copy of the last year's return, the last return that was completed, and then look through that tax return and all the schedules. Okay, because that tax return is a roadmap for her as well as for the tax preparer now, because that tax return is going to have things that are what would be probably normal for that taxpayer, for that person, that family. And so when you're looking through the detail of that return, you're looking for names of maybe investment names, a brokerage company. And so therefore, if you hadn't got a document from that brokerage company, you know that, I may still be waiting for something from that brokerage company. If there was a schedule on there for rental property, a Schedule E, you may know, I need to gather stuff related to my rental property and put that in there. So it kind of depends upon what that tax return has. But then the last recommendation is that you would seek the help of a professional. Okay, the professional's been in this situation before. I know I've been in that situation lots of times where you guide the person. We help guide the person through this process, and really, that person just becomes the gatherer. Yeah. I'm not asking them to calculate anything. I'm just saying, gather this information for me. This is what I expect to see. This is what I expect to have, and this is what I don't have. So, I'm sending them on a chase for the information to file the most complete and accurate return that we can.
There was a question that came in from David, who said that he's grateful that his wife found a position as a remote customer service representative. Are there still tax advantages to having a space dedicated to that job?
Okay, so the short answer is no. Okay, what went out with the Tax Cuts and Jobs Act is the ability to claim unreimbursed employee expenses. So I assume from this question that the person is an employee of this company. Okay, and unless on this on the CSR's W-2 that it's marked that they are a statutory employee, which is indicated, which they will see indicated in box 13. If there's not an X there, there's not an ability to claim any expenses related to that person's job, which includes an office and home deduction. So, for individuals that have expenses relative to their job, their W-2 income, there's no more ability to claim those for tax purposes.
He also wanted to know if there are tax breaks related to the job search for himself.
So know that those would also appear on the Form 2106, which is where a taxpayer claims unreimbursed employee expenses. So those all went out for federal income tax purposes with the Tax Cuts and Jobs Act. And
that went into effect when?
That went into effect at the beginning of 2018.
Okay.
Beginning of 2018. So that part is something not new. I mean, for 2019, we were still under the Tax Cuts and Jobs Act, which was passed at the beginning of, right at the end of calendar year 2017, which went into effect January 1st, 2018.
Interesting. Okay. Shirley wanted to know, what if you take a standard deduction for federal, could it still be beneficial to itemize deductions for Oregon? She obviously lives in Oregon. If not, then she can save time going through all of a whole year's info if it's not going to exceed the federal standard deduction.
Okay. So I believe Oregon is a lot like Arkansas in this area, where you can choose to itemize on your Oregon return while not itemizing on your federal return. There's a separate Schedule A that you can use for Oregon where you may have deductions that exceed the standard deduction for Oregon, but not exceed the standard deduction on your federal return. So yes, it would be helpful if she would, for tax purposes anyway, if she would go through all of her deductions and go ahead and accumulate that for her Oregon return.
All right. Any other advice that you would offer to folks as we close up here? I know we didn't get to the College 529 plans, but in general, they're a good idea if you've got a kid that's headed to college someday, and you can help reduce your tax burden that way. Anything else that you wanted to impart to our viewers?
So, there was a couple of things that that came late at the beginning of this year, actually, that went retroactive to the beginning of 2019. And one of those is the residential energy credits. So if you've had insulation added to your home, if you've replaced your exterior windows and doors, if you had your AC, your central heat and air unit replaced last year, you may be eligible for an energy efficiency credit, which could be up to $500 on your return. So you'll want to be, on the lookout for that. All the, the tax documents that came out early on, because again, this wasn't passed until I think early January. All the instructions that Internal Revenue Service had did not have these as being valid deductions because Congress made that last minute change. So, again, that you could not plan that, considering that wasn't passed until January, but went retroactive to the prior year. But, if so happen you happen to have one of those things done, you could have a windfall and have some extra money in your return.
Okay, good to know.
So,
anything else?
So one thing I will add is that, we've talked about professionals and when to hire professionals. On the National Society of Accountants website, there is a find a professional. So if you find that you need a professional, you can go to that website and click and find someone local to your area, that knows the local tax situation. While I'm here in Arkansas, I know a lot about Arkansas tax and, surrounding states. But, as you drift and each state has their own unique tax situations in their states. So it's helpful to find a local professional in your area.
Got it.
But, yeah.
All right, Brian, thank you so much for your insight. Really appreciate you answering all of these kind of technical questions when it comes to taxes. And we'll be creating a tip sheet, of course, based on the information that you have shared in this interview. Appreciate it.
Well, I appreciate you having me, and it's been my pleasure.
And thank you for joining us for this episode of That Expert Show. We covered a lot of ground. Yes, so we will be posting a tip sheet to thatexpertshow.com. That's also where you can check out previous episodes of the show. You can watch them on YouTube as well, and you can catch our show as a podcast on Apple iTunes, Google Play, Stitcher, TuneIn, Spotify, all those good places. You can connect with us always on social media. I'm on Facebook, Twitter, and Instagram at Anna Canzano. So reach out to me. Let me know what you think about the show. If you have ideas for topics or guests that you want us to cover. And if you get a chance, wherever that you're watching or listening to this, would you think about giving us a review, just a thumbs up or dropping us a nice line? That helps others find us. Really appreciate the conversation that we have on this show because I love the engagement. I love getting your input on what the show should be. That's the whole idea behind That Expert Show, where you help run the show.